So to think that you're going to be able to see an additional 25, 30, 40, 50% discount on current inventory, in my opinion, that's just not going to happen. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello, and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and I want to talk to you about today just stuff that's going on in the market. So several reports came out, and I've been seeing a lot of different things. I constantly try to listen to, the economists, what they're saying, just people way smarter than me that are talking about what's going on, not only in the general overall economy, what they feel like is coming, but also what's happening in commercial real estate, what's happening in residential real estate, what's happening specifically in multifamily, and how it can impact what we're doing at Endurus Capital, and how can it impact not only our current properties but the prospects of future properties. And overall, I actually think, look, we might see a recession coming soon. I think that's a very, very likely outcome coming up. We also might avoid it, and that's fine as well. But one thing I feel very strongly about is that multifamily in the long run is going to be a very good asset. And we're already seeing what looks like laying out the groundwork for multifamily to be an extremely strong asset here, over the next decade plus. And here's what's happening. Well, first of all, let's cover what's happening in the overall economy. So the jobs report came out. There was 272,000 jobs created in May. Now, I think it's important to understand that the vast majority of those jobs were in three industries. So you look at healthcare, government, and hospitality. Now, the government jobs created are the ones that I have the biggest concern for, because those don't create, in my opinion, those don't create a real economy. Those aren't going to help our country overall uh, create more opportunity, create more jobs. So when that number continues to be one of the leading numbers, to me, that's a little bit of cause for concern. Nothing to panic about, definitely, but just something to kind of keep your eye out. And government has been one of the leads, if not the lead. Government and really government support has been one of the leads and top leads for the last year plus when we look at the jobs reports. So I think it's important to say, okay, so 272,000 jobs created. That's 80,000 higher than what's expected. But I think it's fascinating to see that there was 250,000 people that actually left the workforce. And now, who are those people? You've got, baby boomers. Of course, you got people that are deciding to be stay-at-home, moms or dads, entrepreneurs, that type of stuff. But 250,000 people left the workforce. So we're basically, the amount of people that left the workforce, we're just replacing them with the new jobs. Unemployment, 4%. It's the first time that unemployment has been actually over 3.9% since January of 2022. So, although we created a lot of jobs, unemployment is increasing. The concerning part to me is that the labor force participation keeps on decreasing. Only 62.5% of capable adults are actually in the labor force participation. So that's really low. Now, of course, I am probably one of those people because I'm self-employed. But there's a lot of people retiring. The baby boomer generation every single day is adding a lot of people to that on, they're retired. They don't want a job. They're not looking for a job. And so they're out of the labor force. So, you know, again, I don't know that it's something to be overly concerned about, but just to keep an eye on what's going on there. And it really, in my opinion, gives you perspective. Yeah, the jobs numbers may seem high, but when you have as many people leaving the job market as you do coming into the job market, well, that kind of makes sense. So in reality, net job gains are zero. Wage growth is certainly something to keep an eye on. We'd like to see wage growth more into that 2 to 3%. And wage growth is 4.1% year over year. In May, it was 0.4%. And in April, it was 0.2%. Would love to see it around that 0.2% versus the 0.4%. So hopefully that kind of comes back down. Of course, it's great for people who are looking for higher paid jobs, but overall, when we're looking to curb inflation, we can't have 4.1 year over year wage growth continually. That's just not going to help curb inflation. All right, on to the real estate side of things. Rate cuts are probably not likely. We've been holding off for rate cuts, wanting rate cuts. They're probably not likely. And quite frankly, would I love to see rate cuts? Sure, because I've got some properties that we would like to refinance. But with rates staying at or higher than what they currently are, there's bound, in my opinion, there's bound to be more opportunity. There's $669 billion worth of loans that are up for renewal between 2024 and 2026. And this is in the multifamily. Now, what that means is a lot of those properties are going to have a hard time servicing their debt at the new rates. And that spells opportunity. For anybody who's looking for, a deal, that spells a deal. Now, does that mean that we're going to have a ton of distress and we're going to see like crazy amount of deals and wait, don't buy a property until, this starts? No, because this has been going on for a while now and people are working through it with their lender, they're selling properties, whatever they have to do. But I don't think we're going to see widespread distress. I really don't think we're going to see too much distress. Certainly, there's going to be, foreclosure here and there, and a short sale done here and there, and some equity put into deals. But there's a lot of money that's willing to step in and quote unquote rescue deals. There's a lot of lenders that are willing to work with owners of the current property to say, hey, look, here's what we like the property. You're paying your debt. We believe in the business plan and we see the future here being positive. So let's work with you to either extend or modify this loan and see it through to the next up cycle. And so I think a lot of what you're going to see is that. So to think that you're going to be able to see an additional 25, 30, 40, 50% discount on current inventory, in my opinion, that's just not going to happen. Now, could we see another, 5, 10, maybe 15% discount on properties and what we're seeing? Certainly that's a possibility. I just don't see widespread opportunity, and I don't see a reason to not buy today, to hold off for tomorrow if the property pencils and underwrites and makes sense. It just, to me, that it doesn't make sense. You're holding your breath for something that may or may not happen. And we've been talking about this happening. People have been talking about this happening for well over a year now, and we just haven't seen it. So, fascinating. New supply is in Q1 of 2024, it hit a record at 135,652 units delivered around the country. And we had 103,826 units absorbed, which is amazing. What we are seeing is massive amount of inventory hit the market. And by the way, 2022 was a record year. 2023 was a record year. 2024, in the first half of the year, we're having more deliveries in the first half of the year than your typical year does the entire year. So we're seeing a pile of inventory. We're seeing that all swallowed up by tenants, and they're paying really healthy rates. Now, we are seeing the rents decrease across the country by 0.1%. So basically flat. Vacancies are up to 5.9%, but that's still really healthy. If I'm telling you my property is 94% occupied, I don't feel bad about that. Like I'm not distressed that my property is 94 percent occupied. And so the story, in my opinion, is that multifamily is super resilient. We are seeing some declines in rents in kind of the smile states, a lot of people call them. So think of basically all your southern major metropolitan areas, your Phoenix to your Texas, your Dallas and Austin and Houston, and then going over to the East Coast, your Atlanta's, a lot of your Florida cities, South Carolina, North Carolina cities. A lot of those are seeing rent declines. Uh, some of them pretty healthy. Some of them, 5%, 6% rent decreases, but those are the ones that have had massive inventory. Now, the good thing with those markets is that it might take another, 12 to 24 months, but they will absorb all of their deliveries, and then the deliveries kind of shut off here at third quarter, going into fourth quarter. You'll see a lot less deliveries, and then 2025 you'll see a way less deliveries, and so those will get absorbed in 2025 and into early 2026. And then I expect in those cities rents to start really going up pretty quickly in 2026, 2027. And so if you're underwriting in those markets right now today, you probably want to underwrite negative rent growth in the first year, maybe 0% rent growth in year two, and then I think you could go back to that 2 to 3% rent growth in year three and beyond, because I see those markets bouncing back really quickly and aggressively, and probably quite frankly much higher than that 3%. When you look at the inventory that should be hitting the market in those years, it's going to be really slim, while population growth is going to be still very, very nice. And so I see rents increasing on that. Of course, that's all coupled with the fact that, do we have a recession or not? If we have a recession, rents just can't go up that fast. If we don't have a recession, then rents certainly can. Or if we have, inflation that pops back up, it'll be hard to raise rents a ton. So there's a lot in the mix there, but I do see rent growth being a very, very good possibility in the future. In the Midwest, it's a much different story. So, some of those major metros that saw huge rent growth in 2021, 2022 are seeing those big negative declines, and they've seen them over the last, 2 years, where the Midwest is seeing a much different story. And so the Midwest didn't see 30% rent growth. It was seeing very significant rent growth, 9, 10, 12%. But now that's cooled. And it's cooled down to is your typical healthy level of, anywhere from 2 to 5% is what we're seeing. Our worst market that we're in right now, year over year rent growth is 2.7%. And our best market is 5.2% rent growth year over year. And so we're seeing positive in the Midwest. I expect to see that continue. There's population growth in the Midwest happening, healthy population growth, not a crazy amount, but healthy population growth. There's limited amount of deliveries. And again, that slides just like the southern states, that slides here into 2025 and beyond. And so I think those Midwest cities will continue to see a healthy rent increase between that 2 at the low end, but probably like 3 to 5, 6% in most of those markets as well. So it's very fascinating to me is this absorption that we're seeing, and I think it's because of one major thing. home ownership has become out of reach for most people with these interest rates. Prices were skyrocketing and have since really flatlined, but prices were skyrocketing when rates were super low. And we saw these prices get very high and then rates shot up really quickly. And insurance costs shot up extremely quickly. Property taxes shot up extremely quickly. And so the home ownership, it's actually on nationwide, it's $824 per month more expensive than it is to rent. So we're seeing a huge gap there in um, home ownership affordability compared to rent affordability. Most young people that want to buy a house, they just can't afford to buy it. So they're staying in these rentals. They're going into rentals. People are retiring and selling their house right now at very good prices, and they are moving into rentals. So you're seeing this baby boomer transition from home ownership into rentals. So you're seeing a big, huge amount of absorption that's happening that's really taking care of this. What a lot of people thought was going to be really uh, uh, a huge amount of deliveries that was going to just destroy the multifamily world, and it really hasn't. So, um, a big thing for rental operations and for your underwriting, look, rental operations has increased 6.5% year over year, and that's after last year. And I should have looked up that statistic again, but last year rental operations were up about 6% as well. Insurance is up 36.1% year over year. And so if you are in some of these southern states, again, expenses are actually up higher in the southern states. So if you're in some of those southern states and you're seeing rental operations up in some cases 8 to 10%, and you're seeing your rent decline in some cases by 3 to 5%, you're hurting. In the Midwest, your operations are up a little bit less than that 6.5%, and your rents are up. And so in the Midwest, you probably don't have an effective NOI gain, but at least you're not having a big NOI loss. Uh, Multifamily sales down 25.3% year over year. And if you remember this time last year, multifamily sales were down from the year prior as well. So multifamily sales are way, way down. Something to kind of watch. And I think that's why we haven't seen this big, massive price decline that a lot of people see, is because we're finding out that most owners are much more resilient, I think, than the headlines wanted you to believe. And so they don't need to sell their properties. So they're just going to keep them. And why put my property on the market and not get the gains that I was expecting to get? So we're just going to hold on to that property. We're going to hold tight to our numbers, and we're going to wait until the market rebounds before we sell. The longer this plays out, the longer interest rates stay high, and rent stays negative or low growth, and inflation stays higher than rent gains, the more you'll see that inventory go up and the more deals you'll see. But again, I just don't expect it to be this big, huge bonanza of amazing deals. One thing I thought was really interesting, this is just as kind of a side note, is Starlight Capital. They're a big REIT and one of the biggest in the country, and they're not allowing that capital to exit out of their deals. So they're nervous about what's going on, and they don't want this big run on their stock, and for them to get hurt, and have to sell. So just an interesting side note. I don't know, what that means to you, but it's just interesting what's going on in the market, and what other companies are thinking of. Blackstone just came out and said it's a buyer's market. We're buying, we're buying, we're buying. And we'll see if that plays into it. I know they are doing some buying, but we'll see if how true that is. If they can find deals that pencil out. Now their deals how they pencil look a lot different than my deals and how we pencil the deals. So they don't need nearly as big a returns as what we need. They're okay just paying their investors a really small dividend. That doesn't matter for them. So they don't need to make a lot of money for a deal to work. They're just looking for a good place to place their capital. All right. So that's all I got. Just hopefully just a quick rundown on what's going on there. A little bit of helpful. Take this information, do what you want with it, do your own research. I think it's super important to always be paying attention to what's going on in the market, how things are flowing, how things are moving. But look, go out there. I think it's an exciting time. Go out there and find some deals. There's good deals to be had still right now. It's not a time, in my opinion, to put your pencils down. I think we should be underwriting deals and trying to make magic happen, but be patient. That's the big thing is I talk to a lot of people that haven't bought anything since 2022, 2021, 2020 even. And so I've talked to people that haven't bought anything for over a year and they're anxious and they want a deal. And it's so important to be patient and understand you don't need to buy something if it doesn't work. I think that a lot of people are going to be in trouble that are buying a lot of inventory in 2023 and 2024 if they're not being careful, because I still think that there's a lot of bad deals out there. I see them all the time. So just be careful, pay attention to what you're doing. And if you do that and you're aggressively underwriting, not aggressively as far as being aggressive with your numbers, but underwriting everything that's around on the market, off the market, and anywhere in between, you will land something and you'll be happy for that. All right. I'm Todd Dexheimer signing off. Make every day Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.